Okay, hi everyone, welcome to today's webinar. So before I get started, we're just going to give about 2 more minutes to let more people join our session. In the meantime, feel free to let me know if you guys have any requests for any charts. We'll definitely do a little bit of live analysis if we have time at the end of my slides. But we do have a bit to get through today. Um, but yeah, so if we have time, we'll go through some charts. Let me know if you guys can hear me and see me properly, clearly as well, and see my slides. And yeah, we will start in about 2 more minutes. Thanks, everyone. Let's go ahead and get started. So for today's session, we're going to be talking about fundamental trading strategy, the first part of the series. Before we get started, as per usual, a risk warning and disclaimer. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie Chong. I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. So for today's fundamental trading strategy, we'll go through a couple of mistakes that new or beginner traders might make. And we'll go through some tips on how to avoid these mistakes and what you should do instead. Okay, let's get started. So firstly is not having a trading plan. So excuse me. Firstly, a trading plan is important for a couple of reasons. Firstly is consistency, because a trading strategy basically helps you to... Oh, what happened? Can you guys see my screen? Oh, okay. Yeah, we're back. Okay, sorry about that. So, yeah, having a trading plan is important for a couple of reasons. Firstly is consistency. So a trading plan helps you to maintain consistency in your trading approach. So it basically helps you to outline your trading strategy, including entry and exit points, um, risk management rules, and position sizing as well. By following a well-defined plan, you are less likely to make impulsive decisions that's driven by your emotions or maybe market noise as well. Next is objective decision making. So a trading plan provides a framework for making objective decisions. This helps you to define specific criteria for entering and exiting trades based on technical or fundamental analysis. Okay, so risk management. We'll go through some examples of risk management techniques, but basically having a trading plan helps you to incorporate risk management principles that help you protect your capital. So outline how much risk you're willing to take. This is pretty personal and objective, where you should set your stop loss orders and where to take profits. So by implementing these risk management techniques, you can limit potential losses and preserve your trading capital. Focus and discipline. So a trading strategy or a plan keeps you focused on your trading goals and prevents distractions. Helps you to avoid impulsive trades or chasing after hot tips. That's pretty straightforward, so I won't talk about that anymore. If we're talking about evaluation improvement, it's pretty straightforward as well. We'll go through how you can plan your trades by using a journal as well, and which will allow you to make informed adjustments in your trading strategy and continuously improve your trading approach over time. Okay, so confidence. A well-defined trading plan will give you confidence in your trading decisions as well, since it provides a structured framework and a set of rules to follow, helping to reduce uncertainty and anxiety. Okay, so the second mistake that new traders tend to make is not having a stop loss. So in order to manage a trade, it's important to understand what exactly your trade consists of. Okay, so firstly, we have the obvious entry, stop loss, take profit orders, and then we have the break even, partial profit, idea and validation, trailing stop loss, and diversification. So we go through all of these pretty in-depth in our trade management series, but I'll just briefly go through these as things to take note of when you are conducting your fundamental analysis. Okay, so a couple of reasons why it's important to have a trade management strategy. Firstly, is to control risk. Um, so stop loss orders and position sizing help traders to limit their potential losses and manage their overall risk exposure. Maximize profits. Of course, you want to um use trade management strategies like take profit orders and trading stops that help you to lock in profits and maximize your returns. Helps you to manage your emotions. So any trader would be familiar with staying with how difficult it is to stay calm and rational even in volatile markets. Improve trade efficiency. So when you have a well-defined trading plan, it's easier for you to make faster and more informed decisions and avoid the cost and time of having to constantly monitor your trades um, and adjust your positions. Increase consistency. So it also helps you to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. So this is our first example. So the red area shows a strong resistance area. So this is because we have two swing highs that have reacted off of that area. And if our trading strategy requires us to have a fixed take profit of 100 pips, then we would place the target beyond the strong resistance area. Okay, so this is how it plays out. We have our profit target over here. And you can see price shot up, missed our profit target by a few pips before reversing back down. And the reason for this is because price tends to reverse off of big areas of resistance and support. Okay. Now, in an alternative scenario, if we had placed our take profit before the key resistance area, we would have got a profitable trade. So it's important to look at the charts and adjust it accordingly instead of having a fixed number of pips to trade. Okay, so here's the proper stop loss and take profit placement that we recommend. The way that we do it is to place your stop loss beyond a major resistance area and your take profit before. So in this case, since we're going in for a sell entry, you can see that our take profit is below. So we're placing it above this support level, and our stop loss we are placing beyond or above this major resistance area. Yeah, but here is the typical rule to follow. you place your stop loss beyond a key Fibonacci confluence area. Fibonacci confluence, if you're unfamiliar with the term, it's basically when two or more Fibonacci levels line up. I'll show you guys a couple of examples in a little bit, but basically this works for any key resistance levels. So like your swing highs that we saw earlier, or Fibonacci that we see here, or even your pivot levels, so on and so forth. As long as there is a key resistance level, then we would place your stop loss beyond it and your take profit before it. Reason being because price is attracted to strong areas of confluence, and if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So this is one of the reasons why most people wonder why they get stopped out right when the market starts to reverse, and then they might start to complain about stop hunting. Then you want to place your take profit before a key confluence area. Reason for this is because when price reaches the Fibonacci confluence area or any resistance area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back down to your entry, excuse me, or even worse, your stop loss. So this is also one of the reasons why people complain that the market might be manipulated because they missed their take profit by 1 pip. Okay, so here's an example to show you why you shouldn't have a fixed stop loss. Here we have a support level with two swing lows in line with one another. So we have the price that just bounced off of that support level, and we're expecting it to continue to rise to that swing high resistance. Okay, our stop loss of 100 pips is fixed at the 1894.75 level at the support level. Okay, so price goes down, touches your stop loss, but it bounces off perfectly. Okay, so because we mentioned earlier, what we should have done instead was to place our stop loss slightly beyond a key support or resistance so that we are not stopped out at the support, since price tends to be attracted to these key levels of support and bounces off of them. So this is why it's important to have a dynamic stop loss and take profit placement. So basically what a dynamic stop loss is, it's a trading strategy that's used to manage risk, in which the stop loss level is adjusted dynamically based on the market conditions. So the level of the stop loss is continually moved to a more favorable position as the price of the asset moves in the desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses. And the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trend. Okay. So here's a simple example to demonstrate that price has bounced off nicely off of the support level at 86.721, and we are expecting it to reverse off the entry at 87.819 in line with the 100% Fibonacci. Excuse me, in line with the 100% Fibonacci projection level. Excuse me. So you can see here we also have two Fibonacci levels that line up with our stop loss. Okay, the minus 27.2 Fibonacci expansion and the 61.8% Fibonacci projection. Okay, and price is testing the 87.819 level at our entry. So your stop loss should be placed beyond the Fibonacci confluence area instead, like we are doing here. So in this case, since we are going in for a sell entry, you should place your stop loss above this area, and your take profit should be placed above it as well. So you see here, if we had put our stop loss right at the Fibonacci confluence area, we would have been stopped out. And price is often attracted to such areas of strong resistance and support before reversing off of these areas. Okay. So here's another example, or rather, this is what happened from a previous slide. So this is what would have happened if we had been stopped out, if we placed our stop loss at the Fibonacci confluence. And here's what happened. Because price reversed off of this confluence area, we were able to reach this take profit here. Okay. Now, let's look at another example. So here we are expecting price to bounce off of our entry at 87.625 at the pullback resistance in line with the 78.6% Fibonacci retracement. Okay, here price has hit our entry and has reversed nicely off of it and is currently heading towards our take profit. Okay, so you can see our take profit is in line with a 78.6% Fibonacci projection. And price just touched our take profit before reversing off of it. Okay, so that's why it's important for you to place your take profit before a major resistance area. In this case, even though we don't have a Fibonacci confluence area, we do have one Fibonacci level that lines up with a swing low. So this is also pretty strong support level. So yeah, that's why you should place your take profit before any strong resistance or support level, not just Fibonacci confluence. Okay, another example here. This one's pretty straightforward. We have price moving in um recently breaking out of this descending trend line. So it's breaking out. We're expecting price to head towards our take profit. And our take profit is currently in line with this huge confluence area here. We have minus 27.2% Fibonacci expansion, 127.2% Fibonacci extension. And one that's missing over here is also the 78.6% Fibonacci projection. Okay, so in this case, take profit placed above confluence area, we missed our take profit by a few pips. Okay, but if you place your take profit below it, you can see price hits our take profit nicely before reversing back down to our entry. Okay, and that brings us to our next point, which is no risk management. But we already went through this in terms of where to place your take profit. Yeah, so let's move on. Another mistake that people make when it comes to fundamental trading is chasing losses. So this is also what's known as revenge trading, and it happens when you let your emotions cloud your judgment. And it happens even more so when you don't have a trading plan. Okay, so which leads us to another method, which is our break-even point. Okay, So break even in trading refers to the point at which a trade reaches a level where the trader has neither made a profit nor suffered a loss. So it's the point where the cost of the trade, including fees and commissions, is equal to the price at which the trade was executed. Um, yeah, let's just get into how it works. So a break-even level is where you are in profit and you recognize that there's a risk of a reversal back to your entry. So it's basically you saying that if I'm right, price should go all the way to my target, but if it goes back to my entry, then I'm wrong and I should probably get out of my trade. Here we have a entry at the breakout of the multiple swing high resistance level, where we are hoping for price to push to our take profit. Take note of our original stop loss at point 2 at the swing low support. At point 3, price reaches our break-even level and reverses off of it. Hence, we move our stop loss to the entry to protect our position. If price continues to our position, then that's great. But if it reverses back to our entry, we want to be protected. And here we can see price has broken above the break even, but quickly reversed and hit our stop loss. Okay. Another method is partial profit. Um, I'm just briefly going through these methods to take note of to accompany your fundamental trading. These we go in depth when we talk about trade management series, which yeah, we have a webinar series for that. But yeah, if you're interested in that, feel free to request for that. But yeah, we go through it way more in depth in those webinars. Over here, I'm just gonna briefly go through some strategies that you can use. So for partial profit, it's used when there is a strong resistance area and you are unsure if price will rise to take your profit. Okay, so let's just go ahead and look at our first example. So here we have a 38.2% Fibonacci retracement and a 78.6% Fibonacci projection that line up with my partial profit over here. Okay, so this is also what we call an intermediate resistance, but in this case, we're using it as a partial profit. And we are expecting price to rise to our take profit, but because we've identified this strong resistance at the Fibonacci confluence, that's why we're placing our partial profit in case price is unable to break past this area. Okay, so you can see price reacted off of the strong resistance area at our partial profit and reversed off it instead of heading to our take profit. Okay, now we look at break even. For break even, you can see our 100% Fibonacci projection lines up with our entry level, and we're going in for a buy over here. Right, so price broke below this area here, and so we've placed our break even there. And it's heading back down to our entry. Okay, so price bounce off our entry as we expected. It's going upwards. And it hit our break even. So once it hits our break even, we go in and place our stop loss at where our entry is at so that we minimize losses. Okay, and you can see it's a good thing that we did that because we got out with 0 losses here. Okay, and for idea validation, this is another strategy. I know we're going through quite a few strategies today, so just bear with me. That's why I'm just going through it pretty quickly. But basically, I think this is the last strategy that we're going through. But idea validation is basically placed before your stop loss. So it's similar to your break even, but it's the level which you admit that you're wrong and you want to get out of it ASAP. In this case, you're placing your take profit to at your entry instead of previously where we placed our stop loss at our entry for our break even. Okay, so over here at our entry, we're going in for sell, hoping for price to drop all the way down to our take profit target. Okay, and then once price broke out of our entry, um, excuse me. So price is getting out of our entry here, heading towards our stop loss. And it's at this idea and validation level at the swing high that we admit we're wrong and move our take profit to our entry. So this gets us out of the losing trade. So you can see here, moved our original take profit to our entry, and we managed to get out of the trade before price rose further and would have us stopped out. Here, I'm just going to summarize this. So basically, it's the idea behind this strategy was what we saw in the previous slide. But how it works is basically you have the initial idea about the potential trade that's based on your analysis of market conditions that you get from your fundamentals. And then you evaluate on the idea using relevant information, initial trade trade idea, and economic data. Then you establish your invalidation criteria. So what we saw previously was our idea invalidation criteria was if price breaks or if it touches that swing high resistance over here. So that was our criteria. And then the invalidation obviously occurs when you adjust your position, when you move your stop loss, or rather your entry, your take profit to your entry. That's basically it. So if we look at an actual example, here we have our take profit that's in line with a 50% retracement. And we're expecting price to bounce off our entry and hit towards our take profit. Okay. How many validation or criteria before making an entry? So it's okay, let me just get through this example and maybe it answers your question. So in this example, we see price heading towards our entry. We're expecting it to bounce off, hit our take profit. So here we have two Fibonacci levels, the 127.2 and the minus 27.2 as well at the bottom here. Okay. And that's where we are placing our stop loss as well. Okay, and our ideal invalidation is just below that, so that if price breaks below our entry, hits towards our ideal invalidation, we would then place, which is what happened here, we'll quickly move our take profit to our entry. And so if it continues to our take profit, then we would not, or rather if it hits towards our stop loss, we would not be stopped out and we would get out of the trade, like you see over here. So we got out at break even. Okay, so it's not really how many validation or criteria before you make an entry. It's more, this strategy has more to do with finding a criteria or a level in between your entry and your stop loss, so that if price happens to reach that area, you will quickly move your take profit to your entry, and then you get out at break even. That's basically the idea behind it. Okay, so if we didn't do that, price would have stopped us out. Okay, really quickly, another strategy is a trailing stop loss. So this is a type of stop loss order that set a certain percentage or dollar amount away from the market price. So this basically follows the idea that trading stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So here are the different methods of trading stop loss. We have the first one, which is our moving averages. Then we have chandelier, and then we have the ATR, stop loss and resistance, and then the last one is a combination of these methods. Okay, let's start off with moving average. This section is pretty straightforward. So we have a sell entry here. Okay, we're using our moving average. When price moves below your moving average, that's giving you a bearish signal. So our stop loss follows until price touches or crosses over your trailing stop loss or indicator, moving average indicator in this case, then we get stopped out. So that's really it. So it got us out before this happened, which would have resulted in even more losses. Trendline breakout, price is moving in a descending trendline. When price moves above the descending trendline, we will be stopped out. Parabolic SAR, trading stop loss, touches that indicator, we are stopped as well. Chandelier and ATR, can see both of these indicators, we are stopped out when price crosses over them. So it's pretty straightforward, kind of the same techniques, but using different indicators so that you get more confluence on your analysis. In this example, we are using moving average, and you can see price moving above the moving average over here, but price also moved within our take profit here. So firstly, it broke out of our ascending trend line. So that's why we're going in for sell entry towards this take profit level. And price is moving below very nicely. We've hit our take profit, and then we got stopped out over here since price crossed over our moving average. Okay. So an easy way of using trailing stop loss is by using breakouts. And these breakouts are usually high volatility events. Price can spike up and reverse almost as quickly. Stop loss will help you to manage risk and protect your capital, and a trailing stop loss can help you to protect your profit. So I'm not really going to go through these because these are pretty straightforward stuff that we talked about previously. So kind of stop loss, or rather support and resistance levels, moving below your moving average. It's basically a combination of all of the techniques that we talked about earlier. Okay, number 5 is another mistake is over trading. So you have to trade to make money, not trade for the sake of trading. Another thing is ignoring your fundamentals. So here, let's get through some benefits of using a foreign exchange news calendar or economic calendar. Okay, so what exactly it is it basically allows traders to see at one glance all of the important economic data releases. Shows you key events such as GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. So on the left here, I have investing.com. On the right, we have forexfactory.com, which is the one that we typically like to use. But yeah, there are a lot out there on the market that are mostly free to use. So feel free to take a look at those on your own time. Or maybe I will show you guys Forex Factory now. So if you click on today's date, you can look at okay, I think when you go in, the default is today's date with all of the events. Um, so if you click on it, you can control which dates you are looking at. So you can plan it with a long-term perspective if you're looking at 1 month, or you can look at it from a weekly basis. So if, let's say we look at this week, clicking on this green icon, you can also control which event types you're looking at, what currencies you're interested in trading, as well as the expected impact. So the red icon is high impact, orange is medium impact, yellow is low impact, and gray is like bank holidays and things like that. So if I apply my filter, you can see all of the events for this week. Can also give you the timings, the previous data, forecasted data, as well as the actual data once it's actually released. Okay, but we typically will look at the medium to high impact events because there are a lot of impact or a lot of events to get through for most of the weeks. So we'll look at the medium to high when we are trading. Okay, so these are all of the events for this week. And yeah, I'm actually not sure if you guys could see my, yeah, okay, yes. Okay, let's move on. So let's take a look at some high impact events and what exactly they mean. So firstly, we have the US market. We have the medium or rather FOMC meetings, and these are Federal Open Market Committee. It's the US Fed's way of communicating their view on monetary policies. Okay, these usually come together with a Fed interest rate decision. And if the Fed is dovish, the USD is bearish. If the Fed is hawkish, the USD is bullish. If interest rate goes up, the USD is bullish. If the interest rate goes down, the USD is bearish. Okay. Next we have employment data. So the NFP or non-farm payroll measures the change in citizens that are employed from the previous month, excluding the farming industry. Unemployment rate measures the total unemployment of workforce that is seeking active employment from the previous month. And crude oil inventories. These measure the weekly change in the amount of crude held by US firms. So if crude inventories increase, oil prices should drop. EIA, Energy Information Admin, is a short-term outlook. The monthly forecast for the year ahead, demand and prices across major fuel types. Okay, some benefits of using this economic calendars. It depends on your individual trading style. So if you are a swing trader or a day trader, you would probably use this differently. But it basically, all in all, helps you to plan trades and allocations for the day, week, or month ahead. It also helps to alert you of upcoming important news that might affect volatility. Okay, earlier we talked about having a trading journal. So here's some steps to setting up your trading journal. Firstly, you want to choose a format. So this basically determines how you want to structure your trading journal. This can be a physical notebook, a spreadsheet, digital document, or specialized trading journal software. And you want to consider your preferences, and the level of detail that you want to track as well. Next is deciding on the categories. So define the categories of information that you um, want to include in your trading journal. Some of the trade symbols, the entry and exit prices, position size, stop loss and take profit levels, trade duration, um, and obviously the trade outcome as well. Okay, so you can also include other things such as your rationale, market conditions, and emotional state. Capture trade details. So you want to record the relevant information for each trade you make, and be consistent and diligent in doing so. You want to include all the predetermined parameters, exit points, entry and exit points, as well as any adjustments that you made during the trade. Analyzing trade performance, you want to look for patterns, trends, and areas for improvement. Emotional factors, this basically means, this basically includes what we talked about earlier, which is revenge trading, for example, or um, having your judgments be clouded, especially when your trades aren't going according to how you expect them to. And last, excuse me, I'm going to review and adapt as well. Regularly review your trading journal and make adjustments to your strategy as and when it's needed. Maintain discipline. So you want to make sure that you stick to the discipline of recording each trade and consistently updating your trading journal. Okay, so treat it as a crucial part of your trading routine and commit to it. Um, yeah, consistently. Okay, here are some benefits as well. I'm not gonna get into that. I think it's pretty straightforward. But yeah, let me know if you guys have any other questions. If not, I think that's it for today. Yeah, let me know if you guys have any questions. If not, thanks so much for joining me. I hope you guys found this session helpful. I know we went through quite a lot of technical and fundamental techniques today. But yeah, we just wanted to briefly go through each of the strategies just to show you guys what you could be using. Okay. Um, I think that the COT report could is pretty helpful in terms of gauging the sentiment and positioning of, the various market participants in futures markets. Um, but I think it might not, how to say, it might not always accurately reflect future price movements because so it's important to do your own due diligence and your own research. Um, like we went through a couple of techniques that you can use simply because market conditions can change rapidly. So your COT report might not always accurately reflect the changes in the market. Yeah, but it is helpful. Okay. Thanks everyone. See you guys next week. Bye. Have a great rest of your week.